Hey everyone. Today I wanted to go over swing trading options in a general form and why you should not day trade or scalp options. I think that is a recipe for disaster in the long run. Many of you who do watch my channel or do watch the YouTube realm of trading videos, you do know that a lot of it's highly focused on day trading and scalping. Now, my experience, just based off my personal experience, I have made and lost a lot of money day trading and scalping options and shares, for that matter, and futures. Um, for the very lucky few that are able to pull it off, yes, it is great. But for the vast majority of people, you should focus on swing trading. And when I say swing trading, I mean getting into a trade, hold it for a week, 2 weeks. For me, I hold a trade for about a month on average. If you look back through my channel history and my streams, you'll see the majority of my trades, almost all of my trades, are done on a monthly basis. So the benefit of swing trading, in my opinion, especially with options, and I really think the best way to trade options is to swing trade them instead of trying to make 100, 200, 300 bucks in a day really quick scalping or day trading. And the reason for that is because you're letting time play into your trade. You're letting the market um, you're letting the market build your trade up potentially. Now, of course, you can still lose a trade swing trading. You can lose a trade investing. Um, so there's no guarantee, of course, right? And even the way I conduct my trading, I still lose. I can have in my back testing, I've seen win rates of 50%, but um, accounting for depending on how much risk I put into each trade, I could still come out, 100, 200, 300% on a bad year on my account. Of course, you know, those yearly gains that you make on an account depends on how much you're risking per trade. So, how I go about swing trading, specifically options, is going for a longer dated option. Of course, you're going to need a larger account size to do that. In my experience, I've seen, depending on what you're trading, like a stock like NVDA, um, you know, an options contract on a, let's say, 50 days till expiration contract or option, um, you can see those prices to enter that trade just for one contract be around $5,000, $5,500, depending on the stock, right? So usually the higher the underlying, so like NVIDIA here is at 898 right now, the higher the underlying stock prices, usually the more the contract's going to be. That's why right now I'm starting to see NVIDIA, people are starting to call for a stock split, maybe a 5 to 1, 10 to 1 stock split. We don't know if that'll happen. NVIDIA has split their stock in the past, but regardless, in my experience, having like at least at the very least like a $5,000 account balance or preferably $10,000 is where you want to be to start swing trading and be able. And the reason why I say to have that much in your account at the starting point is because you're able to lose a couple trades. Let's say you put on a couple trades, a couple swing trades, and you lose both of them. Um, you still have, depending on how much you risk, let's say you're risking on a $10,000 account, 10%. If you lose 1,000 on one trade and then you lose 1,000 again on a second trade, you still have $8,000 to play with, right? So being able to survive another day or another month in the market is extremely important. So that's why whenever you do back testing and you're researching your own stocks or option strategies, you need to look at drawdown factors. You have to look at market conditions, right, over the course of 5, 10, 15, 20 years. So having a solid strategy, and I'm going to explain that in my video here, And it's I'm going to do a very brief general discussion of my strategy. And I've gone way more in depth on it in other videos. Unfortunately, right now, I can't open up Thinkorswim. That's where I do my back testing and research, and I show you guys examples. Right now, Schwab is taking over Thinkorswim, and they're doing transitions for their platform. So I tried opening up my Thinkorswim, and it's not opening right now. But regardless, I could still explain to you guys the watered down version of my strategy. But basically, I like to go out around 45 days till expiration at the very least. Usually, I'll get in around 50 DT, but that's where you want to be. And of course, the longer you hold a trade, so if you want to put on a trade and hold it for a month, you should be out at least 45 days, because you got to understand, the closer you get to expiration on an options contract, the higher that theta decay is going to be. That theta is going to be higher the closer you get to expiration, right? So, and already when I put on a trade at, let's say, 45 days to expiration, I hold that trade for 1 month. By the time I close it, the contract has, or the option has, about 15 days, give or take, till expiration. So right there, in my opinion, that's risky enough. I've traded the 0 DT, the 1 DT, the low DT options, and I've made and lost a lot of money, like I said. And that's why I'm making this video, to hopefully get a couple people to understand that you don't need to day trade to make a lot of money in the markets in terms of trading options. And I highly suggest just swing trading, because you're able to make just as much money. In my opinion, the most money I've made in the stock market is by swing trading solely. And there's a couple other benefits, which I think are huge. Not only are you not sitting in front of a computer all day doing swing trading, you're able to just put on the trade, do all your research at night, do all your research when you have time available after work. And I'm being realistic. I'm assuming most people are working a job and, they're doing trading on the side. You're able to do your research, you're planning at night or in the morning before the markets are open, and then you execute the trade at any time of the day, and then you hold that trade for a certain amount of time. So that's one of the biggest benefits, is time management. And then also, you're able to focus on your main job. There's two big disadvantages to day trading and scalping. I'm going to put day trading and scalping into one bucket. You have to sit in front of the computer for at least an hour, 2 hours, right? And some days you don't get any trade. Some days the markets trade flat. And then on top of that, you're paying so much in fees. For me, to get in and out of an options trade on one contract is like $5 round trip on one contract. Now, if I'm going to scalp or day trade, I'm trading 10, 20 contracts depending on the stock. And the fees can add up really quick. And believe me, they eat into your account size over time. So swing trading, you're just putting on one trade, holding it, and closing it after a certain amount of time, preferably over a week, 2 weeks, and for me, 1 month. So you need to understand that with swing trading, you're getting the advantages of time management, lower fees, patience, right? So you're letting the market do the work. There's so many times that I've been in day trades where it was working out great, and then all of a sudden the market drops. Or if I'm short, it goes up, and it goes against me really quick, right? And if I held on to that trade, it would have went back in my favor. Everyone knows the story. If you've been day trading or scalping for a certain amount of time, you know how it is. With swing trading, it's the same thing, but over a longer period of time, and you're able to think things through. You're not trigger happy on the sell or buy button. You go into a swing trade with a plan. And I'm going to explain my plan right now. So I like to look at a calendar and just go, okay, I'm going to enter my trade is going to be for, let's say, the month of June. I'm going to go to the next month, right? So I want to put on a trade for the month of June, right? I want to capture the full performance of June, whether it be positive or negative. Now, in my case, I only trade calls. Some people like to trade puts. That's up to you. You have to do your research and find the trades that have worked in the past and then go from there. In my opinion, I like to trade bullish because the markets tend to go up more often than not over, a 20-year, 30-year basis or time period. So for June, I would put on my trade on the last day of May at the end of the day, right? It's around 3:50 p.m. on, in this example, May 31st. And I would buy a contract that is at the very least 45 days till expiration. So if there's a contract that's 43 DTE or 42 DTE, I'm not touching that. I'm going to go to the next DTE. So it could be 50, 55, 49, whatever it may be. But around 45 days till expiration is my threshold. And then instead of going at the money or in the money on a call option, I'm going to go around 45 delta. Unfortunately, I don't have an options chain open. I wish I could show you guys, but if you set your settings, if you don't have settings already applied to your options chain, you want to find a delta. And a delta is basically looking at the change in price for every one tick on the underlying. So if NVIDIA goes up from 898.78 to 899.78, that delta is going to be the gain on your contract. So if it's 0.45 delta, and the delta increases as you get into the money. And you can look at that on an options chain if you're looking at one. So I try to stick around that 45 delta, 45 DTE. I almost want to call it like the 45-45 rule, but that's what I've found works very well in terms of performance, risk to reward. It is risky still. Options itself inherently are risky. So don't think that this is a easy thing to do, and you are going to lose trades using my method. I don't like to call it my method exactly. I'm sure other people do it. Everyone's been swing trading options since the dawn of time. I'm not doing anything original, but I'm doing something that's very simple, easy, low fee, has good time management behind it, and it's profitable over time based on what I've researched. And again, like, this is not financial advice. I'm always going to make that disclaimer. Always do your own research at the end of the day. If you win, if you make or lose money, it's on you. You're the one clicking the button, right? And so am I. So basically what I do is once I'm in that contract at 45 delta, 45 DTE. Now, of course, if you don't have a delta, if you're looking at the options chain and you have a delta of like 40 and then 50, I would probably stick to like 50. I try to round up or down depending on what the market looks like. Of course, the further you go out of the money, right? So if you're going for a 0.4 delta or 40 delta, 30 delta, the riskier the option is, right? But the larger the potential reward is if you're correct. If the market moves in your favor by a large amount, you're going to make more money in terms of percentage gain. So you got to weigh the risk to reward. Again, you could stick anywhere between the 50 to 45, maybe even like the 42 delta. I don't suggest going any lower than that. I've always found that it doesn't really play in your advantage that often. So once I'm in the trade, I hold it for 30 days. Some people hold it for 2 weeks. Some people hold it for more than that. And now if you're going to hold more than a month, I suggest going to a higher DTE. I would look at like a 60 DTE, right? So you got to plan your trade before you enter it. You have to have intentions with it. And then this is the last part, is holding the trade for the entire month. You can't get shaken out. And that's why I always preach in all of my content, live streams, and videos, is to manage your risk at the beginning. So if you have a $10,000 account, let's say, or let's use a smaller example. Let's say you have a $5,000 account and you're willing to risk $1,000. That's 20%. You have to be ready to lose 20% of your account in one trade. right? So when you put $1,000, for example, into an option and you're going to hold it for a month, be ready to lose that. And the importance of holding your trade and sticking to your plan. And you've probably heard this before, sticking to your plan is crucial because you can have a trade that you put on and that stock doesn't do well for the first 2 weeks of the month. And the stock goes down 5-10% and you're down 80% on your contracts. Most people would sell at that point. But the way I think about it is your risk is already managed. You already accepted what you're willing to lose at the get-go. You're not using a stop loss. Now, if you want to use a stop loss, that's up to you. I don't use them because the markets are too volatile. You can get blown out of a trade and then it goes up and then you would have been kicking yourself in the butt saying, man, I would have made 100%, 200% on that trade if I just held it or if I didn't have that stop loss on. So that's why I highly preach just manage your risk with the amount you're putting in instead of using a stop loss. So like I was saying before, you can have a trade that goes down for the first 2 weeks and all of a sudden earnings come out or news comes out or just the market overall does well and you're up 50% on the trade by the last day of the month. That's when I sell for my strategy. I sell. So if I entered this trade on the 31st of May and I'm going to sell it on the last trading day of June, it would be June 28th. So that's it. Now, going into the second piece, how do I apply this strategy, the swing trading strategy, to a certain way to find alpha or yield in the market? This is where I use seasonality, and some people will argue that seasonality is not the best way to trade. I think it's pretty good because you're not looking at technical indicators. You're not looking at a MACD or volume or anything like that. You're just looking at pure price action for a certain period of time. So I'm in NVDA right now for the month of May. Wish me luck. And over the past 20 years, if I take a 20-year look back, and I'm going to notch this time frame back because I want to exclude 2024, May 2024, because it's going to affect the performance. You can see in May, over the past 20 years for NVIDIA stock, has gone up 75% of the time. So 75% of Mays over the past 20 years for NVIDIA stock has gone up. And not only that, if you look down here, 7.3, that is the average gain for the month. So not only am I looking at a month that does well, it closes higher at the end of the month, but it also has a good performance for that month, right? So it's kind of a double layered metric that I look at. I'm looking at two metrics, the win rate of the month, 75%, and the average gain. You can also look at median gain. Median gain is a good measure as well because it can filter out those outliers, right? Because NVIDIA, let's say NVIDIA 2023, if you look at NVIDIA from 2023, this is a monthly chart of NVIDIA. NVIDIA went up 36% last May. Now and that's going to affect this average right here. So, you want to use a median gain at the very least. You can use average as well, but you can use a median gain to get a better idea of where you're going to be, right? It kind of filters out those huge months of like 36%, right? If I look at 2021 wasn't a great, or 2022 wasn't a great year, right? Yeah, so like 2022, 0.67 for the month of May, but 2021, May, 8%. So that's more of an average yield typically for NVIDIA. So, and right now we're up about 4%, recording on May 11th, 2024. So I'm using seasonality. I'm using a planned trading, almost a systematic way. It is a systematic trade in a sense. And I'm using a proper trading plan that I'm sticking to that also is backed by risk, right? So I think risk is like the make or break because I can have a $10,000 account and put 100% of my account or 90% of my account into one trade. And if that trade doesn't work out, I'm done. Like I'm going to have to find more money and deposit it into my trading account and repeat the pain cycle of losing money because you're risking too much. But if you're risking, let's say, on a $10,000 account in one trade, 10%, whoops. If you're using 10%, it's only $1,000, right? And let's say you lose that $1,000, well, you still have $9,000 to trade with, right? Another important thing you want to look at when you're backtesting, and I've done a video on backtesting. If you look into my channel, you'll see the video there. You want to look at risk to reward too. You want to look for like at the very least like a 2.5 or $1 for every $1 you risk. You want to make at least like $2.5 on average. My strategy, it's around 3. So every $1 I risk on average, I'm making $3 in return. So it's a 300% return average. And the benefit of having a higher risk to reward ratio is you're able to have a lower win rate. Now, my win rate varies year to year based on market conditions. And that's the one thing I'm kind of beholden the way I trade. And most people trade, either investing or longer term trading or position trading or holding a trade for a month. You're beholden to the market, right? So if the market does really well, you're most likely going to do very well. And vice versa. If the market doesn't do well, well, you're not going to do well. So you're letting the market kind of take control of what's going to happen, and you're going to have your risk managed from the very start, and you're going to stick to your trading strategy. The way I kind of came up with this idea of trading, and this isn't anything new, but I was day trading and even putting on trades for a few days on a daily chart. And I was looking at the charts and I'm like, man, like trying to use indicators, and it was never really working out well for me in the end. Like I would make money and then lose money, make more money, lose more money, basically just going up and down with my trading account. And eventually I was just looking at the charts one day on a monthly chart, and I realized, I'm like, man, if I just put on a trade simply, let's say at the end of January on NVDA, if I just put on a trade here at the candle close on January and held for the month of February all the way through, I would have made 18%, right? On an options contract, that's a good gain. Like that's probably, I'm just guessing, probably around 150%, give or take, on an options contract. And I'm like, man, why am I looking so deep into charts and technical analysis when I can just look at seasonality, statistics, and then come up with an idea and backtest it within Excel? I use Thinkorswim on demand to do my backtesting, which is decently accurate from what I've seen, and I am forward testing it still too, and it has been working. It proved itself in the backtest, and I'm making money with it right now. So that's why I am making this video right now, explaining why you should just stop day trading and scalping in general. Now, if you have a strategy and it's working for you, God bless you, go with it. But for the vast majority of people, 95%, you're probably going to lose money day trading or scalping. So swing trading, you have a better chance. And even with, like I said before, swing trading, based on my backtest, I can have a 75% win rate for the year, for one particular year. So 75% of my trades win, and I do great. But I have had years where I have a 50% win rate on all my trades for 1 year, and I'm still up 300% on my account. Now, granted, I'm risking, 10, 20, 30% of my account per trade. And granted, I have a smaller account, so compared to my net worth, I'm not really worried about it. And I'm comfortable with losing that amount of money per trade. So in terms of risk. So that's pretty much it. Again, I've made plenty of videos explaining my strategy more in depth. I wish I could show you guys Thinkorswim right now just for an example. But I really want to open your guys' eyes up to how I trade. because it is working for me, and it has been working for me for the better part of about 7-8 months. And I've been trading and investing since like probably like 2018, 2019. So I've been in the markets for at the very least 5 years, and I also work in the financial industry. So I see how things actually work from a high up view, and it kind of kills me to see people day trading and blowing up accounts and losing money unnecessarily. Meanwhile, you can just take a simple strategy like mine, tweak it to your own liking, and hopefully find success. So, overall, I think the hardest part of trading in general is sticking to your plan. Like writing out, 4, 5, 6 bullet points of your trading strategy or steps and sticking to it. And then applying the proper amount of risk per trade. That's it. Keep things simple. Like, don't use crazy technical analysis. I use technical analysis. I like it. It's fun to watch, but it's like 50-50 at the end of the day, right? Whether it's a MACD, a trading trend line, whatever. It doesn't always work out. So I hope I've opened up some of your eyes to this. And at the end of the day, it's really just sticking to your strategy, having a proper psychology, and not risking what you're willing, only risking what you're willing to lose per trade. Because in the long run, even on NVIDIA here, if I put on a monthly trade on NVIDIA every single month, going back, like let's say to like 2017, yeah, there's down months, down 2% here, down 3%, 25%. I would have lost my shirt on these trades. But if I had proper risk management and I stuck to my strategy every single month, I'm going to take advantage of a 14% gain, a 10% gain, a 21% gain, right? And those kinds of gains give you a 2-to-1, 3-to-1, or 1-to-2, 1-to-3 risk to return or risk to reward based on my back testing. And that's why it's important to back test, because you need to know. And the back testing, in my opinion, it bolsters your confidence in the trade. And it also bolsters your trading in the long run, because you could see what has happened in the past. Oh, my account had a 40% drawdown. Well, that happened 2 years ago, or that happened last year too. It's not the first time. But if you just look at the data and the back testing, you say, hey, well, if I stuck to the strategy and just kept going on and had the fortitude to keep going, my account would be back up to new highs over the next 6 months after that drawdown. So, like, at the end of the day, it's psychology, risk management, and then everything else comes after. The trading plan, the discipline, and then finally the technicals, the statistics, the back testing, and so on. So that's pretty much it. I just wanted to give you guys, I know this video is running a little long and I do everything one take, but I appreciate all of you who have stuck around and actually want to learn. Again, my channel, I don't really sell anything. I do have a Discord if you guys want to join that. It's completely free. Just be aware of scammers in there and bots. I try to hammer them away as best I can. And it's a great community. We have like-minded individuals who share their ideas and have had success so far. So yeah. Thanks guys for watching. Please leave a like, hit the subscribe. Let me know what your thoughts are about this down in the comments, and I hope to speak to you all soon. Bye.